That weaker CPI kind of messed with the down open narrative, down now, but certainly turned around. Just look at the S&P futures. I want to show you this 8:30. We had a weaker than expected CPI come out. Yields moved down, and we moved immediately 15 points, in fact, into positive territory on the CPI. And you can see now opening somewhat to the downside. As for sectors, we opened yield sensitive, not surprising, with yields down. REITs, staples a little bit better on the open. Banks notably to downside, yields down, yield curve flattening a little bit. Techs were a mixed open. Intel, Microsoft opened up, but we had some other stuff. Apple opened down, Nvidia was a little bit weaker, so we'll call that a little bit mixed here. There you see the banks on the day before they start reporting earnings, JP Morgan tomorrow, yield curve flattening here. Bank stocks not doing anything at all. When is it going to stop? I tend to always like to look at high volatility events at the VIX curves. VIX cash right now very high, unusually to see it higher than the other future contracts that are out there, because that indicates traders believe there's a short-term event going on that's freaking them out a little bit, and they think it's going to calm down. This is sometimes and often associated with buying opportunities, and I agree with Jim. I think we should let it settle down. But this is nothing compared to February. We were at 50 on the VIX in February. 50. We're at 22 today. Just bear that in mind. A little perspective, I think, important. Yesterday, we spent the day reminding everybody how many stocks in the S&P 500 are down 20% or more. About a quarter of the S&P is down, and that's true. We saw a lot of tech stocks down more than 20% from the year from their highs. But perspective. Look at some of the more defensive names. Look at some of the sectors associated with value, and you see overall they're not far from their 52-week highs. These are 52-week highs. Utilities and energy, real estate, staples, healthcare, not nearly as bad as some other parts of the market. Just keep in mind what's been going on here. And we are up on tech. We are up on consumer discretionary. We are up on healthcare for the year. Why is all of this happening? It's important to remind everybody what's going on. We were in for 10 years, a low-growth, low-yield world. The economy has gotten better. Because of that, we are in a higher-growth, higher-yield world. In the old world, you bought tech because that was the only way to get growth. Now, tech is somewhat less fashionable because there may be other ways to get it. Treasuries are also somewhat more attractive against stocks. That's the key narrative right there here. And whether or not value wins over growth, I don't know. It didn't work in February, but I certainly think it has a better chance of winning right now. This has all gotten the earnings picture much more complicated. Remember 6 months ago, hey, economy's getting better and we got tax cuts. That was the narrative. Look at this narrative now. We have higher rates. We have higher raw material costs. We have higher wages. We have weaker foreign currencies. We have tariffs. We have the potential of a weaker China out there. This is an awful lot for the markets to try to digest. There are a lot of factors here, and the question is, how much weighting do you give each of these factors? This is a different narrative than there was 6 months ago. Bottom line, the world's a lot more complicated, and the stock market is reflecting that the world is more complicated. Guys, back to you.